the common question that we got right when the whole AI conversation started to flare up was, are we invested in artificial intelligence? And my response would generally be something around the lines of, well, what sector do you want to hear about?
Right.
I can talk about how we're exposed to AI in healthcare. I could talk about how we're exposed to artificial intelligence in industrials, even utilities.
Yep.
So I guess the point being, it's ever prevalent. It's evident everywhere. And more companies are talking about it. So what I'm showing on the screen right now is a simple snapshot of the number of companies that cited AI on earnings calls over the last 10 years. And you can see it's no surprise that the last quarter of reporting results, we hit an all-time high of 199 companies within the S&P 500 said or cited AI in some capacity. So number one, it continues to be very important, and I do think it actually is looked very highly upon by investors. So the management teams of these businesses that are citing AI, even if they are not heavily and rapidly deploying investment into artificial intelligence, they still want to talk about it because
that's
the investors
what investors
want to
want to
hear.
Yeah.
Right. So that's first and foremost. So that's been evolving pretty significantly. The other thing I would say is just to keep in mind how dramatic the explosion of artificial intelligence has really been from a return perspective. And it's not necessarily founded in actual earnings growth quite yet. So when I look at key AI players or a select subset of artificial intelligence directly exposed companies, in this example that I'm about to talk through, I'm just using an ETF as an example. I think it's the Wisdom Tree Artificial Intelligence and Innovation ETF. But what you've seen is a really big hype cycle. And when I say hype, I think it technically is correct because it's not necessarily founded in actual profitability yet. There's just a lot of excitement. And so that hype is reflected in a massive degree of market capitalization growth without necessarily having earnings growth to support it. So if you look at the date that ChatGPT was launched, November 30th of 2022, and you look at today, the amount of sheer market capitalization in that ETF I mentioned, those individual companies, that has been added since that date. It's $9.7 trillion. So $9.7 trillion of market value has been created through this artificial intelligence hype. It's hype because the amount of net income that was added in those same companies over the same time frame was $65.3 billion. I mean, it's a big number, but relative to $9.7 trillion, it's nothing. The growth rate of market cap is 87.2% over the period. The growth rate of net income is 14.2%, right? So I think that is just something to be aware of. It's not a comment in favor of or against artificial intelligence in any capacity. I just want to call it out because I think people need to be aware of how quickly and how technically unsubstantiated some of the value creation has been right now. And I think a rebuttal to that would be, well, you know, yes, we haven't seen profitability increase yet. We wouldn't expect trailing profitability to increase. We're pricing this based on future expectations, right?
The market is a discounting mechanism for what's coming down the road.
Yeah, and certainly that can be true. Yeah. But what I would say is that was also what people were saying in 2000, right? Yeah. So when you look at some of the darlings of the tech bubble, I'm showing Cisco Systems, Oracle, and Qualcomm. What I'm showing is the period of time since they reached the stock's high in the year 2000 and how many years it took those companies' stocks to recover back to just even, not even talking about positive, right? Cisco is technically still resting below its 2000 high. Oracle, it took them till technically about 2020 to recover. And then Qualcomm, same deal, close to 2021. So I guess the point is, and I'm not insinuating that buying into some of the hypiest stocks right now, like an NVIDIA, is going to essentially result in this. That's not what I'm saying. I'm just saying be aware of this, right? Yeah. Because right now, just as there was in 2000, there is a lot of excitement around future profitability, new use cases, innovative business models, and a lot of FOMO, fear of missing out. You just want to try to make sure that you're comfortable with the potential risk you're taking. And I would say the last thing is that there are a lot more creative ways to play artificial intelligence relative to just the companies that are in the headlines. And to your point earlier, not just the companies that are in the information technology sector.
Right.
One knock-on effect that you have from this massive utilization and push into artificial intelligence is that artificial intelligence uses an immense amount of data. That data needs to be stored, so data center usage will tick up. And data centers are a huge user of power. They have to be operating 24/7. And a lot of the power consumption growth over the next 8 to 10 years is expected to come from data centers. So what does that tell me? That tells me that if this artificial intelligence hype comes to fruition in a true fashion, we're going to need to build out the grid in a very, very large way. So that's companies that participate in building out gas turbines. It's companies that participate in building out the transmission side of the grid. It's utilities that are deploying capital to make sure that sufficient amount of power is being available to these new data centers. So there are so many different legs that come off of this artificial intelligence topic.
Yeah.
You see a lot of the usual suspects in the headlines, but there are so many other ways to allocate from an investment perspective that might not necessarily be solely reliant on this theme working out for the companies to generate strong returns in the future.
Yeah. Keep our eye on margins moving forward. You'd expect if the artificial intelligence boom continues that companies should be able to leverage that those advancements and be able to increase margins, materially down the road, meaningfully down the road.
Yeah, absolutely.